Oh, here we go, here we go, here we go, here we go. It's Fed Day. Hey, what's going on, everybody? This is the blockchain backer bringing you the latest cryptocurrency news and analysis. Today, it is Fed Day. We are about 8 minutes away from getting the highly anticipated Federal Reserve interest rate hike. Markets anticipate that we're going to see a 0.25% interest rate hike, but typically during these meetings, we do see a tremendous amount of volatility. Sometimes we see it right when the rate hike announcement comes out. Many times it kind of holds off and waits until Jerome Powell does his press conference. So in 7 minutes from me starting this right here, if you're watching on the replay, obviously you could scoot forward 7 minutes and watch what happens then. But in 7 minutes, we're going to find out if we're going to get a 0.25% interest rate hike to the federal funds rate. If we end up seeing something different than that, and the market will be very surprised. So the market has priced in that we're going to see 0.25%. I do believe. Let's see what the current anticipation is right now at 98.7% anticipation that we're going to see 25 basis points or 0.25% and a 1.3% chance of 50 basis points. So as we are getting ready to head into that moment, we could see that markets are hesitant. So crypto's a little bit more red than it was this morning with markets in the morning. We're looking down. I think we were down about 0.5%. Now we're down about 1% is the average across, looking at total, looking at about 0.8% total to negative 1.24%. And what I have here on the top is I have the Bitcoin price chart. We're looking at the 15-minute candles down here on the bottom. We're looking at the Dow Jones Industrial Average, which is also on the 15-minute candles. So as we wait to get this interest rate hike, we'll see what happens. In the markets in the morning segment, I had discussed that sometimes what we see is we'll see that the price will actually be climbing into the announcement, and then we see things just fall apart right there. We're not getting that just yet. I mean, there are still 6 minutes for things to kind of get moving, but we're not seeing any type of rise happening right now. So that's doesn't mean that that's necessarily any type of good sign that that's happening. It's just that each time we've seen it climbing into it, boom, it just falls apart right when the second that rate hike comes out. So, all right. Looks like the alert box. I was trying to mess with it to make it so that it wouldn't make any sound. It looks like I've got a zombie running on the screen now rather than a blockchain backer showing up on there. Blockchain trucker, my dude, what's up, man? Let me. I'm gonna mod you, dude. You don't feel obligated to do anything, but I'm just gonna mod you to make my life easier. If you ever decide to do so, my man, thank you. So we are at this point. We are 5 minutes away. So as you can see on the bottom right side of the screen, and I do recognize the little subscribe button might be covering over that right now, but don't worry, when we get live, I'll shift that thing around. I just didn't want to cover up the charts at this time right now while we're waiting on this. But that will be the Federal Reserve live presser with Jerome Powell. So we'll watch through that. And then I can stick around for maybe 5 or 10 minutes after the presser. And then I do have things I have to take care of in my own life. But we are 4 minutes away from finding out what the Fed is going to do. Are we going to see the infamous 0.25? If we see a 0.25, that will mean we have had 0.75, 0.75, 0.75, 0.75, 0.5, 0.25. Things are slowing down, getting closer and closer to a pause coming. And I've gone through data to show, man, it's actually I get it. The market is pricing in a 0.25. Let me see if I can do this. I only have 4 minutes. Jeez, come on, can I do it? New pane. No, I didn't want that. No. Let's try again. Same percent scale. Turn the percent scale off. There we go. Let's go back in time. Right in here, right back in April, when the Fed funds rate had crossed through the 2-year yield, right? We were at pause, right? So we'd crossed through the 2-year and the 10-year, and that's where the Fed had paused. And so as we can see right now, we're already up here. We've already crossed through the 10 and the 2. And if they raise it again by 0.25 today, they will have exceeded even the last hiking cycle that they decided to keep going, even though they had passed both the 2-year and the 10-year treasury yield. So historical precedent does not say that they do a 0.25. It says that they stay flat. But I'm not going to sit here and argue with the market. I'm going to go in agreement with the market and expect what they expect. 0.25% is what the market does expect. So we'll go ahead and get this on the screen so we can start watching Bitcoin, and we can watch the Dow Jones Industrial Average as we get ready for this show to kick off. And man, I see all the frogs out there, man. And oh man, I'm missing all these too. Reflected Digital, hey, let's do this. Thanks for all you do, brother. Thank you, Reflected Digital. And Cryptofer, my man, dude, we appreciate you. Thank you. That's very kind of you. Appreciate it. So, okay, we are now 2 minutes away. So you may see me kind of have just a couple moments of silence, or maybe I can just try to ramble a little, but I'm definitely looking at multiple monitors right now. I'm trying to get the first take on when that number comes out. So we are about a minute and a half until we're supposed to get it. And we're going to see what happens there when we do. So I'm getting my screens up right now so I can just start F5ing, hitting refresh. We can see the market turning a little bit green, getting ready for this moment. And remember, this could get crazy, man. I have no clue what's going to happen. So here we go. The FOMC statement will come out in 1 minute. There we go. Look at all the frogs. We'll try to do the frogs later. If we get a big green candle, we'll do the frogs. If we get big fat red candles, there's no frogs. It's pump day, my dudes. Oh, geez. I don't know. We're going to find out here in a second where things will get wild. And, even the initial move that we see, we don't know if that's the real move or not. A lot of times they're totally fake. So we got to just kind of say, yeah, JMK. Michael Burry says sell. Jim Cramer says new bull market. The collective mind of the market seems very weary. Yeah, that's one thing that's real interesting. Hold on. We'll talk about that in a minute. I hope I remember to get back to that. Typically, okay, there we go. We got red. All right, so what did we get? I believe we got 0.25. I think we got what we were looking for. I'm not quiet because anything's wrong. I'm quiet because I'm just confirming it. 25 basis points confirmed. Okay. So it is exactly what the market expected it to be. Fed raises benchmark rate 25 basis points to 4.5% to 4.75% target range. Fed repeats ongoing rate increases will be appropriate. So we have gone to where we expected that we would go to. Don't need that anymore. We are now green. This is where we are. Goodbye. Red. And the federal funds rate, this thing right here, will shift to there, exceeding the 2-year and exceeding the 10-year. So how is the 2-year responding? It might be going up. I can't tell. How's the Dow doing? Just go back to this. Here you go. This is what we all came for, right? Let's watch this thing. So, all right. So now we're watching markets move up initially. That the market did do what the Fed did do what the market did expect. Okay. Redbeard. Okay. 0.25. So Bitcoin to 25K. Now we're going to watch the market. So this is where, so now what we know is, so now what we have is that the Federal Reserve has really calmed down, right? So we've seen them go 0.75, 0.75, 0.75, 0.75, 0.5, now 0.25. But they've gone beyond in this hiking cycle further than we've seen them go in the past hiking cycle. So the question is, what will their demeanor be like? What will they talk like during the meeting that they have in about 28 minutes from right now? So that's going to be what we're going to watch. We're going to watch Jerome Powell, a lot of times we could see a lot of price action happen in the market during that moment. But so far, if you remember, we were looking at total. Total was down about 1% or about 0.8%. Total 2 was down about 1.2%. So immediately we've gained back about 0.5%. So nothing bad yet. But I'll get back to JMK right there. You said Michael Berry says sell. Jim Cramer says new bull market. The collective mind of the market seems very wary. And that's very interesting to have that happen at a retrace level like you have with the Dow Jones Industrial Average. Typically at these retracements, you're going to have most people kind of FOMOing in back with excitement. Oh, it looks like some stuff is starting to happen over there on the Fed's end. But I'm not gonna play that just yet. But that is what you're seeing down there on the right side of the screen. I am broadcasting from the Federal Reserve's website. So they're playing some type of maybe propaganda or something. I don't know. Connor Harrison, big candles, baby. All right, we have 2,000 viewers right now. Amazing. So what we're seeing happening right now is we're seeing kind of initial reactions to the market as it did do what it expected. On the top here, I've got the Dow. On the top, I have Bitcoin. On the bottom, I have the Dow Jones Industrial Average. We're just kind of watching the market's initial response. So far, what it expected. Let me see if I can get any other updates over there on Twitter. Outside of them doing it, they said that ongoing rate increases will be appropriate, but that's nothing new from what they've continuously already said. They already said that they expected to raise 0.75% throughout the rest of 2023. Big question has been, are they going to do that in sprinkles of 0.25%? We've talked about this for the last several weeks. As you know, you got it. The market got what it expected. It put a 98.7% probability that this was going to be the outcome, and there was no surprise. So I think the market's probably happy that it was able to read the Fed accurately and put that big of a expectation on it. I am glad to see there was no just crazy surprise. And I'm seeing it was a unanimous vote to raise by 0.25%. So what does that mean? There was no outliers in there thinking, hey, we should be going to 50, or hey, we shouldn't be doing it at all. And they all agreed. And so for the Dow, still, it started off kind of red this morning, and it's still kind of staying there. So I think we're all, a lot of times what we'll see is the initial reaction from the market, and then things will change. But we're not seeing really any reaction from the market at all. I would say that's probably one of the most tame reactions to the Fed rate hikes that we've seen really in the last year. Blurry screen. If you have a blurry screen, maybe try to hit the cog wheel and upgrade it to 1080. It should be coming in strong. Hello, Crypto Brian 17. So on the bottom right of the screen, what you're seeing right there is I'm doing the live feed of the FOMC press conference from the Federal Reserve's website, and now you're going to see it's turning back to watch live February at 2:30 Eastern time, which is in 25 minutes from right now. It's going to be when Jerome Powell comes on and talks. I will move that out of the way. I know it's got the subscribe button sitting right there in front of it, but hey, that subscribe button's sitting there in front of it, so why don't you subscribe and hit the like button while you're at it. Thank you. That does help the channel. I will move that away from the subscribe thing so it's not blocking the view whenever we do get the show on the road here. I'm just trying to really focus more on having the price charts on the screen right now, because a lot of times we see a lot of volatility emerge during this moment. However, one of the most tame ones we've seen in a while, as the market pretty much got exactly what it expected. And then I missed one. Big Candles Baby by Connor. Thank you. And everybody's posting the Froggy. Oh, the frog is still coming out. But we won't do the frog unless we get a really, really good day. I'm still way too on edge because I just don't know how the market is going to react to this moment. But as we now know, we have seen, and like I just showed here, that in the last hiking cycle, by the time the 10-year and the 2-year had pulled down past the federal funds rate, they quit their hiking cycle. And so what we have already seen during the last period was that the 10-year and the 2-year both did pull back past the federal funds rate. like we saw back in here where the Fed paused. Guess what? They did not pause this time. They kept going a little bit higher. So I think that's kind of the more interesting thing about that, is that they're still going, but it's not different from the language that they used in their last meeting, saying that, you know, we're going to see 0.75% throughout the rest of the year. But 0.25? Okay. So, all right. Starting to see some green emerge in the Dow, but really it's going to be about what Powell says. If he's still consistent with that, right, I think the market's going to like it. But, you know, whatever the outcome is, I think it's already all baked into the cake. I do not think our entire economy and our entire livelihoods are based off what happens in this actual meeting. I think it's just interesting, like we're all at these incredible levels right now, like with the Dow Jones and like with gold being at these resistance levels. Are we going to get different wording out of the Fed? We saw Kramer say, hey, everybody, buy it. And yet you have Michael Burry saying, sell it. What's the language out of the Fed going to be? And what we got was 25 basis points. So right now we are 22 minutes away from Jerome Powell coming on, and that will be played here on this channel, which I've got right there on the bottom right side of the screen. You can see it's playing a little bit of their, whatever it is. I don't know what they're playing, but I'm not gonna broadcast that on here. But they will go live in 22 minutes. So is XRP's price range $1 to $1 million? Well, whenever, you know, I think $35,000 didn't get enough clicks on thumbnails anymore, so they went to 50,000, then they went to 122,000. So once $122,500 doesn't get enough clicks, maybe we'll go to maybe it'll be $1 million. The BLS changed the CPI data from 2 years to 1. That will automatically lower the inflation rate without the Fed doing anything else. Yeah. You know, and I'm so, you know, tinfoil hat, right? Like, that's why I have an NFT with a tinfoil hat. I think to myself, like, man, there's 2,200 people watching. Do I really want to do this? Whatever. Who cares? You know, that there's so much focus on, you know, all the manufacturing taking place overseas, at least in the United States there is, right? That it takes place in other countries, but the United States can't compete, right? We can't compete with that because our minimum wage is so high. And not only is minimum wage high, but we have a lot of rights as workers, right? You know, if you're an employer, you know, you've got insurance costs for your employees, you know, paid time off, family medical leave, vacation, and there's workers' unions, and there's all these costs, right? It's just real expensive to have employees. And so it makes it really difficult to compete with cheap labor around the rest of the world. But we're seeing all this inflation happening, but they're doing everything. So like, how do you compete, right? How do you get people to work in manufacturing, like in the masses? How do you bring manufacturing back to the United States without doing it with technology, right? So you could do it with technology by innovation and machines and all that stuff. But if you want to get like physical people working in it, how do you get them to do it? Well, you're going to have to, if you want to compete based on wages, then you're going to have to drop the minimum wage. Well, nobody's going to be happy with dropping the minimum wage, right? Absolutely nobody. So the other alternative is to inflate the currency away, right? So that the minimum wage, which in the United States is like $7.25 per hour, ends up being so low that, you know, everything has gotten more expensive, but they suppress the wages so low that your purchasing power just isn't nearly as much anymore. So they didn't necessarily lower the minimum wage. Everything else just got more expensive. So it was a way to like lower minimum wage without lowering minimum wage. You follow what I'm saying? And so what we're seeing is an attempt to fight wage growth. We're seeing an attempt to make sure that wages don't catch up to inflation. We're like intentionally suppressing wages to keep people poor. And I'm just, you know, put my tinfoil hat on and I think to myself, is that really what the big play is here? Are we really just trying to bring manufacturing back to the United States and make everybody really poor? by stunting wage growth to keep up with inflation. Because that's going to be, I guarantee that's going to be the messaging coming out of here. We have to make sure wages don't get out of control. Why? What's the long play? I don't know. Take tinfoil hat off for a minute. Demi Crummers, thanks for the amazing content as always. What's your TI on Tesla? Does it currently resemble your standard 7-way crashing structure? I'll have to look at Tesla another time. I don't know. I don't think right now is like the appropriate time to. I appreciate the super chat. I don't think pulling up the Tesla chart to dive into it during this stream is kind of the direction I want to go. Then I'll start getting asked about algo again. And then we'll go into every coin. Hey, can you look at this one? I don't really want to do that during this live stream. I kind of want to keep it real focused on what we're dealing with right here. In 17 minutes, we're going to have Jerome Powell come on here and give us a talk. So what we saw is a 0.25% interest rate hike. It's exactly what the market expected. They had a 98.7% expectation that this is what we would see. It's what we got. The market's pretty tame into it. The market had pretty strong confidence on it. So I guess maybe the reason we're seeing reduced volatility is everybody was positioned accordingly. Maybe. And as you can see, I've got my, I tried to turn the alert volume off so that we don't hear alerts. So it's not da-da-da-ding, da-da-da-ding during everything. And I accidentally got a zombie on the screen instead of blockchain backer. So we're going to have zombies today. Sorry about that. Oh yeah, press like for BCB, please. Thank you so much, AK Sammy. Thanks for the super chat and the reminder of likes. Let's take a look here. We'll look at the stock market and how it's responding. It's still pretty tame, right? So how's the 2-year doing? The 2-year, little volatile, but nothing crazy, because that's the one we've been looking at right in here, right? Anytime the federal funds rate goes beyond that, I mean, that's what happened today, guys. I mean, look at the last one, right? So the Fed was able to play, this is a federal funds rate, right? They're able to play catch up, catch up, catch up, catch up, catch up. And then once the 10-year and the 2-year crossed through, the Fed stopped. And we've already had that happen. And now the federal funds rate is above both of them. So even if they raise again, it's still just another step off, right? Like this, going through past rate hike cycles, or at least through the last one that we had in 2018, 2019, 2017, 18, 19. This was, we've just done something different from that rate hike cycle by raising additionally here. So whatever, interesting. BCB, this isn't when moon question, but when moon. Grumpy old man, my man. Yeah, you got to learn how to phrase the question, though. I will see some stuff that is so elegant. They will write full-blown paragraphs, and then it's just, it dances around it, and then asks the question, and I'm like, that was when moon. I know that whole thing right there, that was when moon. Oh, there we go. Connor knows. Powell is going to take the stage and say XRP to the moon. Trust me, bro. JMK, I was looking at Tesla too another time. Interesting stock with how crazy the retail investor hype is. Well, the thing is, like it crashed, right? And then it's bounced hard, right? I think it went down to like 100, maybe 105. And what, it's back at 170 now? I mean, I'm not gonna go full-fledged on this thing. I mean, that's what you got, right? It's a tough one. It's one I'm not buying, but I'm not saying that's wrong. But it's one I'm not buying. The thing is, if this thing went like this, I'd probably regret it. I'd probably expect a pullback from there, but nowhere near to where we're at right now. But, there's so much potential that, you're at trouble spots already. I don't know. I don't spend a whole lot of time in this chart. So I could spend some time on it. The reason why I don't spend a whole lot of time on this chart is the bubble just got too big for me. And after being in just crypto and going through multiple bear markets, that when I see big bubbles get printed like this and big falls like this, and we're not talking little bubbles, right? We're talking like just from C19, right? Let's go to C19 right here. 1,600% in the stock market. That's a big, big bubble for such a short amount of time in the stock market. So what would it take to keep on going, right? I mean, like when Ford did something like this, way back in the day, right? I mean, like everybody's in love with Ford. What do? It's not even as big of a bubble as like Ford wasn't even as big of a bubble, right? From way back here, yeah. But like you look at its final like phase of its bubble, it wasn't as big. It was only like 238%, 316, and this is years, right? This is 1993, 4, 5, 6, 7, 8, 9, 2000 hits the top, right? And that's a 780% rise. Then you start getting some bounces, and everybody gets excited. But look, even to this day, Ford not able to get out. And so I know like a lot of excitement that, hey, there's a bounce in Tesla. But the only reason why it just scares me is just like, it was a matter of how long was it? A year and a half to rocket ship 1,600% in the stock market. So it's kind of crazy. All right. I don't know. I don't spend a whole lot of time on it, but that's kind of one of the reasons why I don't look at it a tremendous amount. Shravan Singh, have you noticed that big price action for crypto comes only weekends, and weekdays it erases that gain? So we actually spent all week last week talking about that like on Fridays and Saturdays for the last couple of weeks, we've seen that type of price action happen. That's not typical. That's not the usual thing. But personally, I kind of like it. It reminds me of like 2017, like in the last year, the correlation to the stock market has just been silly. It's been goofy. Like, in the end, like, it's like, okay, if we break out of like multi-year trends, then that's usually when crypto goes, but it was like tied to it day to day, week to week. There's nothing exciting about crypto to sit here and be like, crypto is this revolutionary thing. It's growing. It's going to become its own thing when you are that tied to the stock market. But like when FTX collapsed, like we've shown it, there was this sudden disconnection from the stock market. I hadn't seen that all year long. And then finally the big blow up and boom, the correlation kind of gets lost. And then on the weekends, we start seeing a little bit of action in crypto, but it's also not like entirely accurate to say it's only on the weekends. It was really only these two time periods. Go back through here. Like this isn't weekend action. This is all, all kinds of action in here at different time periods. Boy, I've messed this all up. But I mean, I get what you're saying. And we have been talking about that a lot. But thank you so much. Pitbull, I always love your content. Thank you, brother. Thank you, Pitbull. Appreciate it. So, guys, where we're at right now is 9 minutes away. It's on the bottom right of your screen. It says watch live February 1st, 2:30 p.m. Eastern time. This is where Jerome Powell is going to come on and speak. And a lot of times we see a lot of the price action in the markets actually take place during that meeting. And so we're going to kind of watch that live. You may see kind of like little short clips that they're running down there on the right side of the screen. I'm not broadcasting those. Sorry, I just hit the mic because they're just not, I don't care about that, whatever they're trying to educate me on. But once Jerome Powell comes on, we'll watch it. We'll see what his wording is, see what he has to say. And I will kind of stay quiet a little bit during that. We'll keep try to play with the location of where that is on the screen. I'll get it behind. I know that subscribe button is sitting right there in front of it. I'll move that so that's not blocking the way. I'm just trying to and I'm gonna do my best to try to keep those price charts on the screen to see if we can see reactions happen as he's talking, the wording, the things that he has to say. And I'm gonna keep myself a little bit quiet during that time, just so we can kind of hear what he says and watch what the charts do. I can tell you, I'm not going to sit here and be able to analyze every word that comes out of his mouth and be like, oh, that has significant meaning. The prices are moving this direction because of the significant meaning of what he just said. I'm not going to be able to be that kind of commentary, but we'll watch it live and see how the prices react. BCB, we do a TA course again that we could buy. Whenever I mean, it's always in the pipeline of like, that's something I need to do. I still, like, as you guys know, people who bought BC Backer, it's been forever, like almost a year now. I've been still adding videos on there for free. I need to make a fresh new one. And I haven't gotten around to it. I've been so busy. I think I've put too much on my plate. I mentioned this the other day that I really need to get an employee, or I got to find some way to get some of the work that I do off my plate. And it's simple stuff like making thumbnails, editing videos. Like I mentioned, one of the reasons I'm always uncomfortable about doing live streams is because when I'm doing my videos, I'm much more of a perfectionist. Like you may hear in my live streams, I'll say, that stuff does not make it into my YouTube videos. That gets cut out. Any of that, just like filler garbage or anytime I take a breath, I cut all that out. So I really try to make the viewer experience as smooth as possible. And I try not to talk really slow to draw videos out and make them longer. I try to talk relatively fast. But I need to take some stuff off my plate so I can focus more on things like that. I would like for it to be more than just TA. I think there's a lot more to crypto we could add in there than just that. But I understand, like, deep diving into trading view, recognizing patterns, applying those things and all that stuff. I think that's incredibly important. Duh. That's what I've spent most of my time on. But, understanding crypto a little bit more. There's so much. Look how many tokens there are on the right side of the screen. What do all of them do? Right? We get new tokens every day. We get new promises every day. So. All right, so we are now 6 minutes away from Jerome Powell going live. Been no significant price action that has happened so far, as the market expected to get a 0.25% interest rate hike to the federal funds rate. It got it. It got exactly what it was looking for. Federal funds rate has now, last time, I think they kind of caught up to the 2-year yield, just surpassed it just a little bit. 2-year yield still never got into that federal funds rate. So as we go into this new meeting, right, it was below 4.25%, which is where the Fed funds rate is, 4.25 to 4.5, and now they go to 4.5 to 4.75. Now we're going to watch. What will be real interesting now for the next time, when is the next meeting? It's going to be in March. I don't know the exact date. But to see if it actually kind of stays here or does it continue drifting down? If it continues drifting down, just like, man, and if they keep hiking, it's just not what we've seen. It's just when these things, and like, I'm looking forward to this updating. I'm hoping this will update on the chart by tomorrow to where we can actually physically see it. Because right now it's still only representing the federal funds rate back till December 1st. So hopefully we can get that updated in there and see the discrepancies between current times and between what we saw during the last hiking cycle. But we are now 4 minutes away. And then AK Sammy says, and for those who are wondering, the next full moon where I live is on the 6th of February. The more you know. Wonderful. Connor Harrison, I want to stack more silver, but it's a dangerous level right now. I'm in the same boat. I love that the premiums have come down, but I'm not comfortable with where the spot price is on the chart. That's where I'm at. So I'm not doing anything. I'm just sitting. Yeah, Kyle, I watch you on 1.5x speed. Yeah, no kidding, man. I mean, I get it, dude. I'm totally the same way. Especially, sometimes the videos are 20 minutes or 30 minutes long. I'm like, when I'm watching, so I have my favorite content creators I like to watch too, right? But I'm kind of like, I don't really have that kind of time right now. I'm gonna pay real close attention to what you're saying, but I'm gonna play you at 2x. Hey, what's going on, everybody? This is Blockchain Backer bringing the latest news, cryptocurrency news and analysis. Today, we're gonna be taking a look at the Bitcoin price chart. Up, down, left, right. All right, 3 minutes away. So hopefully I don't miss. I need to start like kind of paying attention to be ready to turn the volume on, get ready to adjust the screen on where that's located at. Somebody said the DXY is wrecked. Let's go look at it. Not much. There's not much movement on the DXY today. Let's hide this, hide this. It's still sitting there. Still sitting where it was. So what we are doing now, so it's going to get to a period where I'm going to kind of go a little bit more quiet. There's going to be less commentary out of me once this thing does start. And I'm going to let you know, so you guys all know I'm sitting here in the background because I'm not going to like comment on it and stuff. But when he smacks his lips, when he makes these hard swallows, which you will never find in my videos, you will never hear like, oh my gosh, how are you doing that into a microphone? That's a big no-no. Anybody ever out there making content, no hard swallows into microphones, ever. We're going to hear Jerome Powell do that tonight. Throat clears, coughs, hard swallows, all that good stuff. Just know, even though I'm quiet, not saying anything, when you hear that hard swallow, you say, oh man, BCP's losing it right now. So now what's going to happen is I'm going to go quiet. We're going to watch, once this thing starts, I'm going to go pretty quiet. We're going to watch this thing and see what happens with prices as the Fed speaks and see if there's any kind of chaos that comes. But this is supposed to start. Misophonia? I fully believe I do. Mickle. I can't stand it when like I'm sitting at a dinner table and somebody's like using their fork and really grinding it on a plate. Where it like makes you mad. Whenever I'm grumpy, I'm like, I have a disease. I think that's what misophonia is, unless I'm like getting trolled right now. Right? That's the thing where like certain specific sounds and things can like trigger you a little bit. It's weird stuff like that, especially hard swallows. All right, so here we go. We're getting ready. I'm going to go ahead and shush for a minute.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right, we do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation. Quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those 2 options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other 2 sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's, around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is, research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex-housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria?
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee. So
the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're going to write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. You know, let's say inflation does come down much faster than we expect, which is possible. As I mentioned, you know, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, you know, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And, you know, transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. You know, it's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator, of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that The global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months. We've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence
So
metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward?
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. You know, if that happens, if inflation comes down much faster, you know, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, you know, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, And we have inflation moving down, you know, into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, you know, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time. But we thought that, you know, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or, you know, post-meeting statement as an ongoing economic risk, as opposed to, you know, a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, you know, once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't allow to happen. And, you know, so that's why we worry that the longer we're at this and the longer people are talking about inflation all day long, every day, you know, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, you know, we pick that up in conversations, and I've seen some data too that show people are, you know, gradually, they're glad that inflation's coming down. People really don't like inflation. And as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and, you know, high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses. You know, essentially, we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. In this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way, it's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Well, how about that? So, what do we do? I have an idea.
It is Wednesday, my
All right. So interesting, right? Boy, I was watching it with y'all, seeing you guys in the chat. We had the initial boom that happened right there out the gates in the meeting, and then we really turned things around a bit, right? So kind of zoom out on that a little bit. Nothing too crazy, but definitely not anything terrible, right? So it didn't break trends or anything like that. Boy, I saw you guys typing in there about the DXY. I know the Dow Jones, it has gone positive for the day. So we'll go ahead and we'll switch this stuff up right here real quick. Crypto. A lot of green on the board, right? When we started this thing, but that was really red. We've now gone green. We'll see how this reacts after the markets, after Jerome Powell is now done. Looking over here at the stock market is going green. Look at Coinbase. Wow. Up 7%. Wow. Not happy. These are not happy. Let's see. Take a look at this. So, wow. Look at those Treasury yields. Fed raises the funds rate, and Treasury yields, instead of even attempting to try to catch up, they're just saying, nope, good night. And I'll watch that thing again. But boy, I heard a lot of dovish stuff in there. I don't know about you. That especially right out the gates, they were just like, yeah, these smaller ones are what we're thinking about doing now. So it sounds like they're done with anything any higher. Like one of these guys commented and said, you removed a lot of the language that you were saying about worrying about inflation. You're saying about it coming down. So yeah, it sounds like we're much closer to the end on all that than we are at the beginning. So pretty cool. And I did miss a couple in there. DXY. So Grumpy Old Men said DXY just broke the 20-day range. Dow Jones up, so is gold. So the Dow is green. So the stock market is green. Look at the NASDAQ up 2%. Jeez. Dow's up. Gold at 1940. So still not above that daily range high, but definitely poking, right? Wanting to poke. Dow. Boy, how about that, huh? The ultimate battle going on here. For gold and for the stock market, but the NASDAQ up a whopping 2%. It's really, look at all that green in there. The DXY, I saw a lot of comments in there about the DXY. Yep, takes out its daily support that it's been in right in there, right? Let me get these off the screen. There we go. So DXY takes a break through that next support level down in there. So this is the one we kind of talked about where it's like all eyes on this one down in here. See if that one's going to be a holder or if we can plow through that. If we can plow through this guy right there, man, I'll be super excited for equities and for crypto. But definitely this one right here has got me a little worried. But man, can you believe how far this thing has fallen? Unreal, man. Last two times, man, we were seeing just crypto rampaging. And actually, I went through it. I actually did a write-up in my newsletter on this one that we actually didn't really see all the craziness of crypto, right? Like Bitcoin didn't break out of its all-time high, and especially the altcoins, until we actually were all the way down there already. So there actually wasn't a whole lot of action that happened until it got a little bit deeper in the last one. Whereas with this one, we started right around here. Crypto started going nuts during that whole moment. But back in this one, there was a really big delayed lag for it to really start actually further down. So I don't know, but man, look at that DXY go. I'm gonna watch that again, maybe tomorrow afternoon, tomorrow during the day to kind of go through that thing again. But yeah, gold going, Dow Jones up 50 points at one point negative 500, right? What was that at one point throughout today? So at one point, the Dow was negative 505, and we watched it happen right there through the meeting, the volatility really kick in, where it just kind of wicked down, and then now it's positive for the day. Bond yields, treasury yields, not necessarily bonds, bills, notes, treasury yields, all go red. How interesting. Even these long-dated ones, the 10 is down 3%. The 2-year down 2%. The 2-year says, no, we're not going to do it. No, thank you. How about that? So that's our new federal funds rate, 4.5 to 4.75. Crypto. We go green. All right, we survived it. It doesn't mean we're out of the woods, right? It just means we kind of survived that moment, which can typically be pretty crazy. So let's go over back to Bitcoin. Let me see, we still got green, so we'll see if there's more follow through that. Afterwards. We still probably have some volatility throughout the week. Typically the day after Fed meetings, we see volatility as well. but nice to see the markets didn't go like limit down during all of it. I've talked about this many times, and you guys know it too. It's not news to a lot of you that usually the first move is the false move. It's the fake move. And I was watching all of us in the chat. We're all watching it. Whoop. And it's watching the chat. We're like, no. And then whoop, right back up it goes. So the first move was the fake out move. And we see that all the time. Smitty, I saw Smitty during the middle of that. Break the wall. Come on. And it's still just fighting up in there. But the Dow did give a little push, but the Dow pulling back too. But Dow got up a little bit higher. So I would say went pretty okay. Yeah. And there was a lot of stuff in there that hinting that they're done. They were talking about it, like disinflation's in the works. Things are coming down. It was not that harsh rhetoric that you're used to hearing, and then them saying, real clear that, smaller rate hikes are appropriate. So this narrative may be coming to an end here pretty soon with the Fed hiking cycle, but okay. We survived that moment, and crypto went green for the day, along with everything else. But hey, take a zoomed out approach. Where are we? We still sit here. But that's a good sign. That's a good sign. So, you kind of look to how things kind of happened in here, right? What did we do? We kind of curled up, fell, and then this was kind of the beginning of it, right? So we'll keep an eye on it, and we'll watch through tomorrow and see if there's some more follow through with this tomorrow. But Courtney Smith, thank you, Courtney. Such a big supporter of the channel. I've been meaning to say to follow you on Twitter. I see your inspirational stuff and the things you're trying to achieve. It's very inspirational. Keep it up. You're going to do great. And thank you for your support, and happy Wednesday to all. Otherwise, man, dude, I thought that went pretty well. Outside of price action, I thought it went pretty well. So, green day, guys. It's been a day for me for sure. Get all those squigglies off there. As we saw, fake out move, recovery. Now we'll kind of let it kind of settle in. And I'll check in with you guys tomorrow. And we'll have our normal stuff tomorrow. We'll have the markets in the morning. We'll get a video out there. I know the videos have been spotty. I know we've been doing markets in the morning every day, but videos have been kind of spotty just because there's been so much on my plate. But we'll be fine tomorrow. We'll get it all knocked out. And then I will catch you guys in the morning. So made it through that one. Hopefully we got more. So, all right, guys, I'm going to go ahead and I'm going to wrap this one up. If you could, please like the live stream. I hope that you guys are having a great Wednesday. We're halfway through the week. We played It's Wednesday, my dudes, many times. Have to wait till next Wednesday till we can do it again. But otherwise, that's going to be it. All right. All right, guys, that's it. Thanks for watching. If you could, please like this live stream and give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice, and I am not a financial advisor. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. And if you like what we did today, leave a comment below. Maybe we'll do it again. Have a good one.